Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to leverage analysis. This will be one of two problems of its kind that we will be working through. Leverage analysis will be related to the financing of the business, where we have two different options. One's going to be leaning towards the debt financing option, the other towards equity financing option. We'll see the difference between the two. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 533 Leverage Analysis Problem 1 tab in the Practice Problems section. Closing this back out, we're going to read through the information up top, and then we'll go through a smaller component of that information as we use it to fill out the practice problem. We're going to be looking at two ways to think about our financing options, meaning the financing of the assets. One being more reliant on debt, having more leverage. The other being more reliant on equity. So we're going to say that the assets are going to be the 12 million. We've got the debt at the 6 million. The rate for that debt is 11.5, and then the common stocks is at the 6 million here. So we got the split, even split. You can see this is basically our accounting equation here, right? We've got the assets at the 12 million, and then the split out between liabilities and equity, that split being the 6 million, 6 million, the amount that is at the debt. Then of course we have to pay interest on it, that being the 11.5%. The common stock that is out has a $9 par value. So then we're going to have the refinancing options. One going to be more focused on debt, so we're going to lean our financing of the assets more towards debt, whereas the other more focused on equity, leaning the financing of our assets then towards equity financing. So the return on assets before interest and taxes, the return that we're getting on the assets, so that's why we have assets in the company, because we're getting a return on those assets. We're going to say that return is going to be 11.5% before taxes and interest. The tax rate, 30%. Then if there's any loss that we have that we're going to be calculating, notice that if you have a loss on taxes, we have to think about, well, what's the tax effect on the loss? Because they're not going to give us money if we lose money, right? Well, they might give us money if we can roll it back or roll it forward. That's how the taxes work, meaning if we have a loss, the government doesn't pay us for the loss. When we make money, we have to pay taxes. If we have a loss, they don't typically pay us. But if we can roll the money back to a period where we had income, we might be able to take advantage of the loss. That's what we're going to assume to be the case in our practice problem. So plan that's going to be debt focused, the debt focused plan then, we're going to say we have long-term bond is going to be the amount of $2,980,000. So we're going to issue a bond, issue debt, a bond that's going to be a payable liability on our books. It's going to cost us a 12% rate for the bond. We're going to take that money that we get, the $2,980,000, and we're going to purchase back our own stock that is actually on the stock market. And what this will do will, of course, reduce the amount of equity that is outstanding and basically transform that or move the equity into debt, meaning we're now financing our assets more with debt, more leverage than with equity. We're going to remove the equity investment and shift it over to the debt. Now, to do that, we have to purchase our own stock back from the stock market, and their current price is 9%. That happens to be also the par value. Don't let that throw you off. So we have the price. This is the market price that we have to purchase it back for, 9%. Then we have the plan for the equity plan. Let's go to the other extreme and say, well, what if I want to refinance with equity? How could we do that? Well, we could say, why don't we issue more shares of stock now? And we're going to be issuing 331,111 shares, because that's about the same amount that we saw up top. So now we're going to take this 331,111, issue them. We're going to say the market price is $9, and that's going to be our 2 million about, right? So it's rounded here. So just note that we're going to have rounding involved in this problem, but it's about this number taking into consideration rounding. And now we're going to basically take that money and pay off the debt. So instead of us taking a loan out, we're going to pay off the loan. How are we going to pay off the loan? We're going to issue stock, meaning now we're, kind of diluting the value of the stock, because now there's more stocks out there. And we're going to take that money and then pay off the debt with it, which is going to lean our assets are going to be now financed more with equity than with debt if we do that plan. So here's going to be a quick recap of that information so we can look at it a little bit more easily as we work through the practice problem. So here's our worksheet up top. We're going to work through this. We're going to basically put together an income statement, but we're going to start the income statement at the point in time of the earnings before interest and taxes. That's when these two options are basically the same up until that point, and then we'll consider the interest and the taxes, which is where the problem will diverge. We're going to have the current plan where we currently have in terms of our currently financing plan of the assets. Then we have the debt plan, the debt related plan, the equity related plan. All right, so we're starting off with the earnings before interest and taxes. We said that we had a turnover of 11.5. So of the assets that we have right now, this 12 million, we're getting a return of 0.115. So that's going to be the 1,380,000 that we're going to be receiving. That's going to be the same whether we have the current plan, the debt plan, or the equity. We're not increasing the assets and therefore not increasing our return on them. We're just simply refinancing the financing options between the debt and the equity. So then we're going to say, all right, and the interest this is where it's going to change now between the two plans. Currently, we have the interest, we have debt outstanding up to 6 million and the rate at the 11%. So we're going to take the 6 million times the 11% times 0.115. There could be rounding that's going to be involved here, not this time. So that's going to be the 690,000. Now on the debt plan, we're going to take out more debt. We said we're going to now issue bonds of this amount. That's going to have this interest rate, and we're going to use that in order to purchase back stock. So we got to think, okay, now we're going to have more debt, and so we're going to have more interest that's going to be involved here. So let's go down to our worksheet down below and work this out. I'm going to say the beginning debt was that 6 million. The interest rate was at 11.5. That's going to give us our same 690,000. Now we have more debt, which is going to be that 2,980,000 that we're going to be adding to it right here at a rate of 12% interest. That's going to give us then total interest, if we multiply them out, the 357,600. So 357,600 plus the original interest of the 690 is going to give us the 1,047,600. 1,047,600 on the interest for the debt plan. There we have that. Now the equity plan is going to reduce the interest because we're going to issue equity. We're going to take that money and pay off the debt. Now, there could be rounding involved in this one, so be careful here. So we're going to say the beginning debt's going to be the 6 million. We're going to say that we're going to pay off then 2,980,000. And notice that that number is slightly rounded because how did we get that number? We're selling stocks, and we sold the 331,111 of stock at $9, which is really this 2,979,000, but that's because this number's rounded right here. So notice we rounded this number. So really we're going to use the 2,980,000 and round it up to the same amount that we basically had over here for the new debt. So we're doing kind of the opposite of the new debt. And so if we take the beginning balance minus the payoff that we're going to be paying off the debt, that means our original debt is now down to 3,020,000. We're going to multiply that times the 11.5, which is the same rate on that original debt. And that means that now under this plan, we're at the 347,300. So 347,300 here. Then we could subtract this out and say, all right, that's going to give us our earnings before taxes. So we're at the 690,000 here. The debt plan 332,400. The equity, of course, is the highest because we don't have to pay as much interest on the equity plan. However, we have diluted the stock and issued more stock out there. So we have to basically distribute the earnings and the value of the stock over more shares. Then we have the taxes that we're going to be applying out. So we're going to apply the taxes. And we said the tax rate was at, what was the tax rate at? 30%. 30% tax rate. So notice the tax rate, if we multiply this out, of course, we got the original plan, 690,000 times 0.3, 30%, 207. Now the debt plan, if I take the 332,400 times the 0.3, is going to give us less of a tax effect. So we pay less taxes. Why? Because our taxable income is lower due to the fact that we had to pay interest. So we don't like paying interest, but at least we get to deduct the interest most likely for taxes, which means that the tax amount is less. The equity plan, we have a higher income before taxes, and therefore the government, wants more of our money. So we have to pay the higher taxes under that plan. And then we have the earnings after the taxes. That's going to be subtracting these out. Earnings before taxes minus the taxes gives us the earnings after the taxes. You can see here's our current plan in the middle. The debt plan has the lowest amount, but we also get to distribute it over less shares, and so we'll think about that in a second. The equity has the highest amount because we didn't have to pay the interest, but we're going to have to then distribute that over more shares because we issued common stock in order to generate that revenue. So now if we think about the common stock, then the original common stock that was out there was the original common stock we had at a par value. So we took this 6 million divided by 9, and that's going to give us about this 667. And then we've got the debt plan under. We purchased some shares back here. So we issued the debt and then we purchased shares back. So how many shares are outstanding now? We purchased back this 331, which is about it's rounded again because we had the debt that we had here, and then we purchased back as many shares as we could at the $9 price. So if we take the 2980000 divided by 9, we purchased about the 331111 shares back. So if I take that and say, okay, now we're going to reduce the number of shares that were originally there. So this is going to be a negative number, but minus the 666667 we get about the 335556 for the number of shares that are left on the debt plan. So now we have less shares that we have to allocate across. And then let's just think of the last one. On the equity plan, then we have more shares because on the equity plan, we issued more shares. We issued this 331,111 about times $9. And really, again, it's this 2980000 divided by 9. So it's that number times the $9 price, and that's where we're getting the 2,980,000. So we issued those shares out. So now we issued these 331,111 about. So 331,111 plus the 666667 is going to give us about the 997,778. So now, even though we have a lot more income over here on the equity plan, we have to distribute them across more units, more shares. Now, it doesn't mean that those units might not be held again by multiple people, might hold multiple shares. But notice there's more units that we have to basically spread that over because we issued more stock, issued equity investment in order to generate the revenue in order to pay down the debt. So then if we get our earnings per share, then where's that going to stand? At the 483,000 divided by the 666,667, that's about the 72. If we take the 232,680 divided by the 335,556, that's about the 69 cents. And then the 997,778 divided by the 772,890 is about, let's do that one more time. I did that backwards. So 722,890 divided by the 997,778, it's going to give us about the 0.72. So we can see here, even though the current option before we do the refinancing and the equity option have different numbers in terms of the earnings after taxes, basically net income, those two are resulting in the same earnings per share due to the more shares that have to be distributed. And notice that's also going to be basically a result of the fact that the rate on the original debt of the 11.5 is the same as the return on the assets at the 11.5. Now, the debt plan resulted in lower earnings after taxes and also ended up with a lower earnings per share. Part of the reason of that is going to be the rate that we have on the debt. We've got that 12% rate on the debt, so it's a fairly high financing within the debt. Now, again, if you were to mix that up, if you were to have a debt plan where you increase the assets or the revenues were increasing, then again, that could be another factor that could lean towards a debt financed plan. But obviously, the rate of the interest is going to be one factor. We didn't change any assumptions in terms of the growth of the companies not increasing. We didn't increase the assets in order to try to increase the sales. And therefore, we're just doing a refinancing plan and everything else basically being equal. Okay, so now let's do another scenario down below. Now we're going to calculate the earnings per share if the return on assets before interest and taxes was 5.75. So we're going to be basically lowering it now, because before we're saying the return was at the 11.5. So now we have a much less earnings or return on our assets. Before we work through the problem, let's just think through what the possibilities will happen here. We're going to say that we have a lesser return. So we have the same amount of assets. We have a lesser return. That's going to result in the earnings before interest and taxes being less. If that is the case, you would think that the debt-focused plan would be doing worse than before, and the equity-focused plan may be doing better in terms of the financing. And in the opposite situation, you would think the leverage may play a beneficial role as your returns on the assets would be increasing. So let's go through that and think through that. Let's take a look at the calculations. Earnings before interest and taxes now. We're going to say that we're going to get a return on the assets. The assets are at the 12 million times the return, which is 0.0575. That's going to be the 690,000. Then we're going to have the interest calculation. So the interest calculation, the original debt was once again that 6 million. So we'd take the 6 million times the 0.115, and that's going to give us our 690,000. On the debt-focused plan, we have the same calculation that we saw up top, in that we had the original debt and then the new debt, giving us that 1,047,600. Remember what the plan was, is that we issued the debt and then we bought back the stock with it. So now we have more interest on that plan. The equity plan, we have the same format up top. Remember what the plan was there, so we're going to issue more stocks, and then we're going to use the proceeds from the stocks in order to buy back some of our debt. Therefore, the debt under that plan was reduced, and that results in the interest then being reduced for that plan. So then we're going to be subtracting out the interest. That gives us our earnings before taxes. Notice that the debt plan is now negative because of the high interest rate that we're going to be paying. So we have a negative in earnings before taxes. Equities at the 342.7. The current plan where we currently stand is at the 0. Then notice on the taxes, you're going to say, well, what do we do with the taxes now when we have a loss here? Because if I have the taxes and it's a negative 107,280, what does that mean? Does that mean that the IRS is going to pay us? And the answer is, well, kind of, because they're not going to pay us on this year, but if we can carry it back to a prior year that we had earnings and take the loss against that year or in the future, then we can get a tax benefit from the loss. And that's what we're going to assume to be the case here. So the tax rate was the 30%. That means on this item, we're going to take the 357,600 times the 0.3. We've got the 107,280 tax benefit, which will actually be reducing then the earnings after the taxes, or the loss. It reduces the loss. So now we have the loss of the 250,320, and on the equity side, we actually had to pay taxes over here, and we have the earnings after taxes at the 239,890. Then we consider the number of shares. Once again, we have the kind of same breakout with the shares that we talked about before. The first one having the 667, the second one having less shares on the debt plan because we took the debt out in order to buy back some of the shares. The third one, we issued more shares, so now we have more shares. So note that on the equity-focused plan, it's the only one where we have basically income here, but we have to allocate that income over more shares. The debt plan, of course, has a loss, which we're allocating the loss over. So the current plan is at 0. So if we divide this out, then the 250,320 over the shares outstanding, we have a loss of the 0.75. And in the equity plan is the only one that's resulting in the earnings per share at the income of the 0.24. So now let's do the opposite. We took it down, the return on assets. What would happen if calculate the earnings per share if the return on assets before interest and taxes was 15%? Now, what would be the result that we would expect in this case? If we increase the return on assets, then our income before interest and taxes will be going up, and you would think then that the leverage could have a beneficial impact. So that would be the prediction here. Let's see what plays out. We're going to say then that the earnings before interest and taxes is going to be the 1,800,000. That's going to be calculated as the 12 million times times the 0.15, that's going to give us the 1,000,008. They all are starting at that point. Then on the interest, we have the same kind of format, your same plan as we did up top, whereas we have the interest of the 1,047,600 for the debt plan and the 347,300 for the equity plan here. Same calculation or same plan that we have. That's going to give us the earnings before taxes if we subtract these out. And then we're going to have the taxes on that. So here's the taxes at the 30% of this number. The debt plan now is resulting in less taxes, of course, because we had the more interest. And then the equity plan here, then if we subtract those out, we're going to say now we have the earnings after taxes. Earnings after taxes. Notice the equity plan, of course, still resulting in the highest earnings after taxes, but they have to be allocating those again once again across the debt across the shares that have been distributed, which there are more now. So if we were then to take the number of shares, same calculation on the number of shares that we saw in the past. So we got the same breakout because they are the same plans. But then if we do our division problem, we're going to say, well, now if we divide this out, we're going to say, all right, it's a 777,770,000 divided by the 666,667. That's how our calculation's going. We get about 1.17. If we do that across here, now we're seeing that the debt plan, although it has a lower earnings after taxes, if we break those out because there's less shares outstanding, then we're actually having a higher earnings per share than we had on the equity focus. So you can kind of see the effect of the leverage that is happening there as we increase our earnings. As the earnings go up, you could see a positive lean towards the debt, and then if the earnings were to go down, then you could see a decrease. Now, notice again was a refinancing problem. We had a refinancing problem here where we didn't increase basically the asset level. So we could think of problems later where we're going to say, hey, if we're getting a return on assets, what would happen if we would basically finance an increase in the assets, as opposed to here where we basically left the assets the same and just refinanced the debt and the equity. So that's another set of problems that we can think about what the effect of the leverage would be on them.